Brought to you by the Every Dollar app. Start budgeting for free today.
My name's Elliot. I graduated from a top 20, business school in college. After college, I sold triple net investment sales for about 2 years. And then for the last year, I've been a whole life agent that, in Louisville, we partner with many different working class companies. For discussion purposes, the average American retires with about $5,000 in their bank account. Personally, I tell my friends and family, to cash out their whole life policies. And the way I pitch whole life, it's not necessarily as an investment vehicle, but more so as a savings or a savings account, but simply as insurance that accumulates cash value and a paid up coverage over time.
Yeah, so what this individual is covering is what appears to be becoming a trend financial mechanism, which is whole life insurance. So this is different from term life insurance. So classically, term life insurance is what you're likely most familiar with if you are working with an employer who has a life insurance benefit. This is the type which is like other insurance that you have, like for your car or for your home. You sign up usually at a year cadence. You pay a particular price, and then it insures you for whatever incident occurs over that time frame. So for a term life policy, basically what this means is if you were to pass away in that year, or the individual who is insured passes away in that year, then it triggers, and then money is awarded to basically their family or their beneficiaries. Whole life insurance is a different type of policy. I don't have all of the details, but I think the high level ones this individual has already kind of highlighted. So the way it works is that basically you pay for a policy that basically lasts your entire life, your whole life, which is why it's referred to that way. And what happens is that you basically put in money, and then this money basically goes towards the premium of the insurance. And then there's some extra that gets held onto. So basically, in a sense, this is like a forced savings plan. However, it's not as good as other mechanisms. So for example, like if you had just automated a payment to the S&P 500 or to a mortgage or something like this, that could be another version of this mechanism where like you're forcing it into a particular area. One of the reasons why this is particularly not good is usually the premiums are higher on these types of policies, even compared to a term, meaning you pay more money for less end benefit. And while there's this interesting kind of cash balance mechanism that exists, if I'm not mistaken, I think the way they mostly work is that they allow up to a certain percent growth rate. So I think classically it's like 5%. So that means they invest the extra cash value, I think, into the market. And so the market itself, like if you think of the S&P 500, can swing up like plus 50% or minus 50%. And it generally averages out to about positive 10%. But this isn't because every year you get 10% on it. It's a combination of some years that are plus 20, some minus 10, some plus 30, minus 15, minus 20, plus 10, and then they all average out to this positive number. And what this policy does is it basically caps out the amount of growth that you can have on the account to 5%, meaning basically you get barely any of the upside to having your money in a market or in something that accrues interest. But then they allow you to get 100% of the downside, meaning if the market goes down 50%, they will allow your account to go down 50%. So they don't cap it on both sides. So effectively what this means is that they allow you to get some benefit, but they shield you from the best part of investing, and then they make you susceptible to the worst part of investing. So it skews the risk reward profile of an investment very much into the risk area, and you barely get any reward for it. And so this seems to become a popular trend, potentially due to salesmen like this, who seem to be pushing for these policies nowadays, likely because they have a higher premium, meaning the insurance company gets more money from a particular individual. And they seem to be kind of toting them as these like magical scenarios where like you can invest and you can like get loans out from yourself and from this policy, and you'll have money when you pass away, and you will have something for your family to inherit. Um, but again, this is a scenario where when you get into the details, it mostly is a higher premium, meaning they're charging you more money, and then they're basically hurting you with any extra money that you have in that policy. And so this has actually been something that seems to be quite prevalent, especially on social media at the moment, which is actually a pretty unfortunate circumstance where hopefully people are finding better financial advice for themselves. And so I guess we'll see. I think Dave and George here are going to be chatting with this salesman, and maybe they'll cover some of these aspects.
In my eyes, I believe I'm leaving my members better off than before they talk to me, but why am I doing something so horrible in your eyes?
Well, because the product is crap, not because you're a bad guy, but the product that you're selling, you're trying to do a good thing, Elliot, and thank you for doing that. And I appreciate your heart, but basically, I mean, it's a math problem. So if you take a $200 whole life premium per month, I can buy the same amount of term insurance on that 30-year-old for about $10. So the other 100.
Yeah, so Dave is covering one of these already, which is the premium aspect. I'm not sure how representative these numbers are, but my understanding is usually the premium on a whole life is magnitudes larger. So in this case, he's referencing it's potentially like 20x what it could be otherwise a month. And so I do know that they are usually drastically higher than they would be for a term, but I'm not sure how much data is backing Dave's exact numbers there.
90 would go towards cash value in the typical policy, the top 10 stock companies out there, okay? That's the actual data that's out there in today's market. And so if I'm paying $190 extra for the life insurance in order to create a savings account, that's not the end of the world, but it's the rules of the savings account that are the cash value. We'll call it savings. You said we're using it as a savings vehicle that are the problem. The typical whole life policy accumulates zero cash value in the first 3 years. Have you noticed that?
Yeah, I know that.
Okay. So it's called what you and I, people in the financial industry, like you, me, and George, we would call that front-loaded commission. Agreed?
Yes.
So I have a savings account that I'm putting $190 in my example in per month, and the first 3 years I get zero. It 100% goes to the bank, goes to the life insurance company. Okay? After that, the typical whole life policy accumulates at a 1.2% rate. Some of them go as high as 3 or 4%. Some of the universal policies will go as high as 4 to 7%. Some of the indexed universal policies that are indexed to like an S&P after fees will go as high as 7 or 8% rate of return.
Yeah.
Okay?
Yeah.
But the typical basic whole life policy, not a universal policy, is accumulating at under 2%. So I have a savings account that for the first 3 years I put money in it. They keep my money. After that, when I finally start saving, it accumulates at 1 to 2%. And here's the thing. Okay, now what would be, you say, Elliot, in your case, the typical size face value of policy that you sell is? What's a normal policy for you?
You know, it's going to vary from someone who's 18 to, 70.
Okay,
right?
so, but I mean, you're out there selling. Who's your typical customer? Let's say you had a 30-year-old.
Yeah.
What would you?
The typical customer is Joe. He works construction, and
so he's probably not doing a $200 a month premium like I'm using as an example. Then.
No. For me, I've never sold a $200 a month premium policy.
So probably more like 100.
On average, it'd be more like between 50 and 70.
Okay.
I would say.
All right. And so these are $50,000 face value policies, right?
Yeah, or less.
Yeah.
I would say.
Okay. So they're small policies. Would you agree with me that a guy that makes $40,000 a year and dies, $50,000 is not enough to take care of his family?
Correct. It's not enough to take care of his family.
If you wanted to.
So it's actually great that Dave is going through all of these numbers here. He seems to actually have some of the data backing some of his earlier claims where he was kind of going through some of the standard numbers and the expected rate of returns. And again, this is where they're going to be covering, this individual is kind of highlighting a construction worker. And I think this unfortunately kind of goes back to what I had highlighted earlier with social media, which is to some instance, it seems as though these types of salesmen, this one doesn't seem to be aware necessarily of what he's doing in full context necessarily. He seems like he believes he is doing something good for these individuals, but in many cases, this is actually to somewhat a predatory option for finances. Again, because this individual who he's highlighted as a construction worker, I'm going to assume he makes less than 50K a year. I think the average American, especially in that type of work, is probably around 40, like Dave said. And so taking $75 a month from this individual is definitely going to be adding up over time. And so this is something where, again, Dave is highlighting the fact that you don't actually earn any money on it off of at the beginning. And so this is somebody who is probably on that lower end of the pay scale. And this is an individual who maybe in an off season could really use an extra $500, an extra $1,000 to help tie him over to avoid other worse scenarios like getting credit cards, doing like payday loans, those types of scenarios. And so these are the individuals who likely aren't even aware of other financial vehicles that exist. And so again, it feels almost predatory in so much as like they're coding these policies as sort of these like savings mechanisms, which is his own word, which is definitely not how I would describe it. If anything, it's more of like a wasting money scenario where it's going to steal money away from you in the short term. And when you do classic investments, the money you put in first is actually the money that makes you the most over time due to compounding interest. And so this is where like these policies are actually stealing this away from these individuals. And so this particular example, if they had just put that in, maybe even just their savings account, Dave had even highlighted like 1% or so. High yield savings accounts right now are still probably about 4% interest rate. So that's where literally if he just stored it in a bank account, he'd be earning 3-4x the return as this policy. And all of that money would be his. It wouldn't disappear, whereas it would for this whole life policy. So just to go over that again. So basically, as Dave was highlighting, like if it's $100 or $200, the insurance company just pockets that money. That doesn't go anywhere. That doesn't go back to you. It doesn't get returns. But in your bank account, if you're saving $100 a month, that's like $1,200 a year. In 3 years, that could be over $3,000, $3,000 to $4,000, depending on the payment option here. And then that is also accruing interest. So you could be getting close to like $5,000 depending on what type of vehicle you are using. Whereas in the example he's giving for this construction worker that he's selling it on, it could be that this individual basically is just short a few $1,000s over this 3-4 year span and doesn't really have anything else as compensation for that time. Just the insurance company has gotten it. So if you can compare those scenarios where you could have one individual who is down $2,000 or $3,000, or the same individual who could be positive $3,000 or $4,000, that's a huge difference in what could be a make or break scenario for them. Maybe they have a health emergency, a family emergency, car trouble, something breaks in their home. That money could do a lot of good for that individual. And so these policies are definitely much better for the insurance companies than they are for the individuals involved. So definitely glad to see that Dave is going through all those numbers.
Replace a $40,000 a year income, you would need north of $400,000 invested at 10%.
Correct. And
Yeah.
but I would say it's better than nothing.
Better than nothing,
time.
but for the same money he's spending, he could have bought the right amount of insurance if he bought term.
Right. And the funny thing about term too is I talk to these people when they hit the age of retirement, and they're like, "Yeah, I paid in this life insurance my whole life, but then I never used it," and they're so upset with me about it.
Yeah.
And
no, they're not upset with you. You haven't been selling long enough to meet anybody that kept it till retirement. You just started, but that they were could be upset with the industry maybe. But that I haven't had that problem because here's the thing: if you take the $10 a month and you bought let's drop it to $5 a month and call it a $70,000 policy.
Yeah.
After let's go back to our savings account. I was using 190 a while ago. Now I've got to drop it down to about 95 because I'm $100 a month policy. Okay. Now, if we're going to do that, $5 is covering the insurance, 95 is going into the savings program, 0 for the first 3 years. After that, it's accumulating at 2%. And after that, if it builds up a cash value of $5,000 or $10,000 after 10, 15, 20 years, right?
Yeah.
Okay.
Right.
They die with a $60,000 whole life policy with a $15,000 cash value that they've paid extra to build the cash value. With a $60,000 whole life policy, would you agree with me that the insurance company is going to send them a check for $60,000?
Only the $60,000.
Exactly.
Correct.
So you paid for a savings program, and when you die, they keep your money.
Wow. So I actually didn't know that aspect as well. So again, one of the aspects that this individual, the salesman themselves, were kind of toting the program. He even highlighted in his own example, he sort of corrected himself a bit of like, he even highlights these as savings programs for his clients. And I didn't hear that either when I first looked into these policies. So what Dave is highlighting and this individual confirmed is that even the savings program that he is toting as one of the primary reasons why you'd want whole life insurance, if you actually have any cash value in there when you were to pass away, then that actually just like gets absorbed by the insurance company. So again, this is where there's so many mechanisms where they're stealing the interest, they're withholding whatever cash value is remaining in there from your family and your beneficiaries. And so it's just segment after segment where like they're just literally stealing dollars away from these customers. And so as far as I can tell, this is a terrible insurance vehicle. I don't think I've really seen any positive cases. I think some might include folks who are potentially like quite wealthy as potentially ways of maybe tax avoidance or something like that. I'm sure that there is some very slim case where this is beneficial, but for the vast, vast majority of individuals, this is definitely going to be a detrimental financial vehicle to be using in any capacity.
Yes. Yep.
Nice parting gift.
That's why we think it sucks, man. It's zero. 100% is kept for the first 3 years. After that, it's accumulating at a lousy rate. And when I die, you keep my money. I paid extra beyond term to get whole life to get a whole life policy that has a savings program in it. And my savings program, when I die, doesn't go to my family. It goes to the insurance company. If I opened a bank with those terms, the bank would go broke. No one would put savings in there.
So it's not enough to actually cover and replace income, and you don't actually get the cash value when you die. I'm confused.
The only thing that I will say, I think a problem that it is helping is that people do only retire with about $5,000 in their bank account.
Well, so that's because they bought this crap.
They didn't have any money to invest because they gave it to you.
If you put the $95 in a Roth IRA, they would retire millionaires.
Yeah, but I don't think I'm putting a policy in place where it's like that uncomfortable, where they didn't have enough money to invest on top of that.
Why don't they use the money to invest wisely?
If I showed them an investment calculator and I put the same amount in there, they would be flabbergasted and they would be running far away from this product.
If I bought term life insurance and wasted all that money for my whole life and ended up a multimillionaire as opposed to an insurance company keeping my savings that I paid for, I don't think anybody's going to be mad about that, Elliot.
It's like telling someone, Dave, this show is great. In season 12, it gets good. If you can get through the first 12 seasons of this show, I promise it'll be mediocre at best.
I'm not binging that.
No, thank you.
Elliot, I think you're probably a good guy, but I think you're probably, if you keep doing the math on this, you're going to probably end up doing a different type of financial planning that's more beneficial to the folks you're trying to serve. This is The Ramsey Show. So if you look in the skyline of the typical mid-sized city, the towers in the skylines, particularly 20 years ago and before, it would be two things: banks and life insurance companies. Santa Claus did not build those buildings. You did. You did. Your money went to them. You chose for it to go to them. They didn't steal it from you. But their products are so profitable to them, not to you, that they own the Skylines. Don't you just wish you had the bank furniture? They got the best furniture. So when we talk to a young man like Elliot who's selling whole life insurance, or an old man or an old woman that's selling life insurance, whole life insurance, we find the only people that believe that rhetoric, that line that we just covered with him, and honestly, to his credit, I think he truly believes he's doing good. There's two types of whole life insurance agents as far as I'm concerned. The ones that understand they're screwing people and the ones that don't. And he's one that he doesn't. He really thinks he's doing a good thing. And so, but I have done a lot of enthusiastically stupid things too. By the way, folks, I'll help you with this. You get screwed way more often by enthusiastic ignoramuses than you do actual con men. There's not that many actual psychopaths out there like a Bernie Madoff. There's a few of them. But your friend who's trying to talk you into Bitcoin is an enthusiastic ignoramus.
It's actually a great scenario that Dave is covering at this moment. I would say I've certainly fallen for some of these things myself. I think exactly what he's probably going to be covering here, which is when you're interacting with another individual who's trying to put you onto a product or a service or join some random thing that exists out there, and they don't believe it's good for you, sometimes you can pick that up during your conversation as you ask questions, as you try to dig into it. And for those scenarios, I think mostly I have avoided them for the most part. But especially earlier on in my life, and I'm sure it still probably happens here or there, these people who are ignorant to the negatives of what they're doing are so much harder to figure out because as you ask them questions, you mostly get their enthusiasm and some data that they have that makes them believe that that is accurate. And I think this is one of the scenarios that is one of the hardest to cover when you're having an interaction with one of these individuals. And I know scenarios where this has happened to me, which is like they had this individual, Elliot, who actually believes he's doing a good thing with this whole life insurance policy. And so it's very possible that somebody told Elliot misleading information or potentially lied to him outright about the data behind these policies. And he might be unwittingly passing that information on. And so if you're just using that one individual's word to make your assessment, it's going to be so much harder because they believe what they are telling you. And so that's going to be a very hard scenario for you to get around because then they're going to give you data that kind of backs it up potentially in these cases. And those are really hard scenarios to avoid. And so at least the best advice I can give for individuals is when you're in one of these situations where somebody's trying to sell you something expensive, maybe sell you something that's going to be lingering around for a while, always try to ask to follow up with them. It could be as simple as tomorrow. I found that if there's a situation where something nefarious is happening one way or the other, these individuals will push you to transact immediately. So I think classic examples are like car salesman, probably this life insurance salesman as well, because in this case, if they are ignorant to the fact that this is a negative policy and they think it's really good, likely the person who's giving them this information is also telling them strategies to force a transaction right away. And so this is where they think it's good for you and they'll likely do the other things that they were trained for. And usually these nefarious segments will push to have transactions right away. I've never been at a company or interacted with a company or a salesperson who was doing legitimate business when I said, hey, I will need to get back to you tomorrow. I just need to run through the numbers myself and I'll be good to go. Have had any issues at all. I have run into scenarios where if you're kind of being pressured or they're using like scare tactics or maybe trying to pressure you into making decisions and you ask to do it another day, usually these people will actually like get more fierce and aggressive about you trying to transact. So maybe you'll say something like, hey, actually, I think I'd rather just review the numbers and take a look again tomorrow. classically what these individuals who have these nefarious products would do is that they'll say, well, what's going to be the difference between right now and tomorrow? Because why don't you just make the transaction today? Or, hey, how about I give you this deal? If you do this right now, I'll give you 10% discount, 20% discount, and I'm going to take that discount away tomorrow. These are all classic examples of trying to like force you to kind of want to transact at that moment. And in my mind, these are all bad signs that something isn't everything that it's supposed to be. And so the best advice I can give again is if you're going to be taking on one of these scenarios, just sleep on it, take a day, do some research independently, because this is the next best follow-up action is try to gain information about this thing or this product from somebody who isn't the individual or the company that you just interacted with. And likely that will be all you need to kind of get a sense of whether they are up to no good or not. And that can be just enough time for you to avoid a really precarious situation.
They're not con people.
They're just passionate.
Probably even the little fried kid that is going to jail or whatever.
Sam Bankman-Fried. Yeah.
He might not even be a real crook. I don't know. I haven't really looked at the details of that. He might just be a massively enthusiastic ignoramus. You know what I'm saying? And so really what you've got to do is you have to follow the money. And you know, be a fruit inspector. What's the fruit of the products? When we talk to multimillionaires and millionaires, we don't find them using payday lenders, rent to own, whole life insurance. We don't find them using rip-off financial products. They have avoided those things, and it's one of the secrets that causes them to be wealthy. And that's really where, you know, this stuff breaks down. And so, I mean, I have really good friends that used to sell whole life insurance, and once they actually, because I just pound the crap out of them, but I mean, they finally just like, I get it, and I can't sell it anymore because I have a conscience. Mm. You know, if you have a good friend that is a payday lender and is ripping off poor people at 800% interest, that's called oppressing the poor. You do not want to read in the Bible what God does to people who oppress the poor. When you mess with the poor on purpose, screwing them, and you mess with widows and orphans, you don't want to be on that list in the Bible. It's not a good list to be on. And so you don't want to be on the wrong side of a financial product and be justifying it, well, it's better than nothing. No, it's actually not. You'd be better off putting your money in a fruit jar. Create your free every dollar budget today, the simplest way to budget for your life.
Thank you for watching. If you like what you saw, please hit like or subscribe. I'll see you around.